JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by a view on the domestic debt markets, which could in turn impact the positioning of our schemes. During the month, 10-year US Treasury yield inched up, closing at 4.93%. Also, the spread between the 30-year US Treasury bond versus 2-year US Treasury bond has converged to around 1 basis point, as against 118 basis points in June 2023. This is because the 30-year closed at 5.09%. The inversion has reduced as the 2-year has remained elevated while the 30-year US Treasury bond has hardened considerably. US Treasury continues to remain elevated given that labor markets are still very tight, retail sales remain strong, and growth remains resilient. A higher for longer interest rate expectation given a sticky inflation trajectory above the 2% inflation target and an unfavorable demand-supply dynamics given high fiscal deficit concerns coupled with quantitative tightening regime by the Fed are driving investors to demand a higher term premium, causing hardness in the 30-year US Treasury. The 10-year Japan government bond yields have hardened by 18 basis points during the month on building expectations of a change in its ultra-loose monetary policy. The Bank of Japan, in its policy on 31st October 2023, maintained its key short-term interest rate at minus 0.1%. However, adjusted the yield curve control policy, wherein the upper bound limit of 1% will now be considered as a reference and not a cap, implying that 10-year yields can now potentially go beyond 1%. The 10-year government bond yields in Germany, on the other hand, closed at 2.80%. The Germany and Eurozone provisional October consumer price inflation printed at 3.8% and 2.9% respectively, lower than expectations. Further, provisional GDP growth of Q3 once again shows a deterioration of 0.3%, being the third consecutive quarter with negative growth. Brent crude oil remains the joker of the pack, oscillating between $84.07 per billion barrel to $95.31 per billion barrel during the month. Onshore, the 10-year Government of India bond yield ran up post the Monetary Policy Committee announcement on 6 October 2023 by 15 basis points to 7.36%. This was mainly due to RBI's announcement that it is open to conducting sales in open market operations going forward to manage liquidity. The 10-year GSEC traded in a band of 7.22% to 7.38% and closed at 7.36% in October 2023 as compared to 7.22% in September 2023. Headline CPI inflation for September 2023 printed at 5.02%, significantly lower than August's reading of 6.83% on a year-on-year basis. CPI inflation moderated below RBI's upper tolerance band after 2 months. Decline in CPI reading was largely attributable to food, especially vegetables, and fuel segments, which noted a sharp sequential decline of 1.82% and 3.68% respectively in September 2023. Further, core inflation moderated to 4.53% in September 2023 from 4.79% in August 2023. All components of the core basket noted a decline in year-on-year inflation compared to the previous month. Liquidity conditions continued to remain tight during October. In the MPC policy on 6 October 2023, RBI has spelled out its intent of managing liquidity actively as sustained periods of excess liquidity remains a risk to price and financial stability. Daily average borrowing through MSF window increased to Rs 1.1 trillion from Rs 946 billion in the previous month. Average systemic liquidity deficit stood at 521 billion rupees as compared to a deficit of 175 billion rupees in September 2023. Credit growth stood at 19.3% as on October 06, 2023, marginally lower than 19.8% as on September 8, 2023. Deposit growth stood at 13.6% as on October 6th, with a marginal decline over the previous month. Overall, credit growth for the month of September 2023 stood at 20%, marginally up from 19.8% in the previous month. Credit growth was led by personal loans, services, agriculture and industry in that order, with year-on-year growth of 30.4%, 25.1%, 16.8% and 7.1% respectively. Key takeaways for us from RBI's recent monetary policy are: RBI has kept key interest rates unchanged. RBI has forecasted CPI at 5.2% for April to June 2024 quarter, which remains higher than the target of 4%. RBI has clearly mentioned that keeping inflation within the tolerance band of 4% plus minus 2% is not enough and would aim to get it to target of 4%. Inflation target of 4% on sustainable basis seems distant as of now. Recurring food-led CPI, lower kharif crop sowing, El Niño conditions, volatile energy prices may anchor into higher inflation expectations. RBI has mentioned that India's growth is likely to remain resilient and may surprise positively. RBI has also mentioned that globally, policy rates are likely to remain higher for longer. Given these macro dynamics, we feel there is no visibility of rate cuts as of now. For the bond market participants, given the first two takeaways on growth and inflation, directional moves are being dictated by the third assumption, that is global rates remaining higher. We remain vigilant in tracking this assumption as every now and then positive economic data is getting offset by softness in data such as high level of bankruptcies in US in recent months. Also, Eurozone and China are showing signs of slowdown on a quarter-on-quarter basis. The Bloomberg probability of recession in the next 1 year in Eurozone shows a 50% chance, while for China it's increased from 10% to 17.5% since mid-September 2023. Consumer demand in the US is expected to remain stable in the coming months as income increases are keeping pace with the rise of credit card balances. Average hourly earnings in the US has seen a slight slowdown but still exceeds inflation, signifying an improvement in the purchasing power. Will US companies maintain slimmer profit margins or pass on increased labor costs to create a wage price spiral? With credit card debt soaring and personal savings sinking, is the personal household excessively leveraged and a cause for concern? Given the higher rates, will the higher leverage further eat into personal savings? These are questions that remain to be answered. Since a lot of uncertainty still exists, central banks of most major economies continue to be watchful with a hawkish bias. US carries on with its quantitative tightening schedule and has successively reduced its balance sheet size from $8.9 trillion to $7.9 trillion in the past 7 months. Interest rates continue to be higher for longer, and at the margin, liquidity continues to drift lower. The uncertainty related to the geopolitical events remains on the table. For Asian central banks, the external environment has become more challenging with higher US rates, broad USD and oil prices. Some central banks like Indonesia and Philippines are back to hiking rates. Domestically, real rates remain positive, with the repo rate maintained at 6.50% and the forecasted CPI for April to June 2025 quarter at 5.2%. Real rates are now positive 1.3%. However, the 1-year forward inflation is still high, and RBI would aim to get it to the target of 4%. RBI has summarized this very well, that it's a turning wicket and would be selecting shorts carefully. Given these, we feel there is no visibility of rate cuts as of now. At this stage, we remain cautious and have positioned lighter on duration across our schemes, reflecting our readings of macros.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.